so that we kind of have some direction in terms of that. That'll just help us. So I got one no so far. Anybody else? Anybody join us last yet? Jonathan, you were here. Yep. Welcome back. And Robert, also welcome back. Carol will maybe do a quick recap too in the very beginning, so they will do that. All right, so I'm going to get started. As we typically do, I just like to go through a little bit about SCORE and kind of talk to you about that, and we'll go from there. So yeah, we're looks like we're getting more people. So for those who just jumped in, will you let me know if you were on last week or if this is the first week of the two workshops that we're doing that you're on? Just let me know. Again, I just, Dave can probably do a quick recap. I'm going to start talking a little bit about SCORE and then we'll move on to the actual presentation. So SCORE's got the largest network of free volunteer small business mentors probably in the country. I think I mentioned this to those that were on last week that we've got some 240 chapters throughout the country. So just like the one here in Cleveland, they're all over the country. It's a national organization. The parent national organization is out of Washington, D.C. We've been around for probably close to 70 years in total. So we've got a lot of experience. There are about 10,000 volunteers in the SCORE organization, 90 here in the Cleveland area. So that's, we've got some really good, strong people that have great business experience working with us. Our mission is to foster small, vibrant business communities through mentoring and education. Just like the workshop that we're doing tonight, we do about 150 workshops a year. And so, you're welcome to join any of those at any given time. We probably do 2 to 3 a week at least. So you all know that the small business drives the economy. And that's why the SBA, which is part of, we're an SBA partner, has really pushed SCORE and worked with us and working with small businesses. We know how critical it is. Somewhere close to 50% of the total economy is small businesses. So that's, anybody under 500 employees. We typically work with much smaller businesses than that, but we're here for, the life of your business from the time you start your business, from the time you have an idea, all the way through when you're ready to sell and work out of your business. So we're there, and we do have clients that we've done both for over the years. We've got clients that we've had over 20 and 25 years. So in 2022, you can see we started about 500 new businesses, created somewhere in the vicinity of 800 jobs. And the chapter services are basically anybody that comes to a mentoring session, anybody that is online with one of our workshops, anybody that goes online and looks at the national workshops. So I mentioned that we're part of the SBA, but all of our services are free. We do not charge for anything. So if you're working with us and you've got a SCORE mentor, there's no charge for that, and it's unlimited. So we will work with you as much and as often as you need to be worked with, or as you want to be worked with, and that's pretty much the way we work. I'm going to go to the SCORE website real quick, and let's see if that'll open up. So this is our home page, and this is the best way to request a mentor. You can also browse the profiles and take a look at what the mentor's experience is. Most of our mentors should be listed here. You can also just go to request a local mentor and fill in the information. But if you do have a mentor in mind that you want to work with, you can request that mentor directly. There are also mentors, as I mentioned, throughout the entire country. So there are, the possibility for you to find somebody that's not out of Cleveland is there if you wanted to do that, and you found somebody who's got a special area that you need work with. If we don't have it here, we can also pull in other mentors from other parts of the country. The other really interesting thing about this is that we've got templates, we've got resources, we've got all kinds of information that's available to you, and it's all free. So feel free to get on there and browse and take a look around. Also, if you're interested in becoming a volunteer, becoming a mentor, there are opportunities for that as well. Many times, I've found clients that I'm working with that I think should be mentors, and actually have asked them to go ahead and volunteer, and some of them have. It's just a great way for us to expand our network of volunteers. So that's pretty much it. Um, National Business Plan Month is, I think, this month. And so, if you are starting a business, go to the startup roadmap. If you're, there are great financial statements around. So if you're going to go to a bank or to a lender like what Dave represents through Comstar, this template, this information that's on these statements are something that you're going to want to bring in as part of your loan documents. They will talk about that in a bit. So now I'm going to get out of this and go back to the slides and turn it over to Dave. Give me one sec. And so I'd like to introduce you to Dave Javeski. Dave is President and CEO of Comstar Credit Union, a wonderful partner for SCORE. We refer clients back and forth to one another, and Dave is just a wealth of resources if you are interested in looking at financing your business. So Dave, take it away.
Hey, thank you very much. I appreciate it. And thank you for everyone who carved out some time this evening to join us. I know everyone's itching for the holiday season and the new year, so I appreciate you sitting in with us. And if you were here last week, also thank you. And if you weren't here last week, that's okay. We're going to go over some concepts that are going to carry over from part 1 to part 2. And I'll be referring to some of those things. But if you need some clarifications, please down in the chat, make sure that in that chat you put your questions, and then we'll get to them as soon as possible. So, okay, if you had at the end, you'll see my contact information at the end of our presentation, so don't worry about that. We'll get to that in a minute. So in part 1, this is a 2-part series, and one of the reasons why I love teaching it, this is Comstar's 86th year. We've been doing business lending for a long time, which is not something that a lot of credit unions do, or at least they didn't used to do. One of the reasons why I love business lending and love teaching this class is prior to my life in credit unions, I owned a small business, and a partner of mine, we tried to get a small business loan, and, we filled out all the paperwork and, documents that seemed to go on forever. And then there was kind of this period of time where we really didn't know what was going on. We knew that the application was being evaluated, and then we got a denial letter. And so when I started to do commercial lending and joining credit unions, I decided that it would be nice for small businesses to kind of pull back that curtain between the borrower, the lender, and how they evaluate risk, why certain financial institutions say yes more to certain things, say no more to certain things, and just kind of explain what is going on during that period between, application submission, approvals, denials, all those kinds of things. So that's kind of what this 2-part series is about. And then later tonight, at the end of part 2, we're going to talk about, what happens, the relationship between the borrower and the financial institution after funding the loan. So that's an important piece that a lot of people may not know. Well, what's going to happen after I get the money? So that's kind of what we're going to go over tonight. Some of the important super highlights for part 1 is about the banking relationship, making sure that whatever financial institution you choose, whether it's a regional bank, community bank, credit union, what have you, make sure that your needs fit their business model. There's a lot of financial institutions that offer business accounts, but that doesn't necessarily mean that they are comfortable with your loan request. For example, some financial institutions will not do floor plan loaning. Some will not do accounts receivable lending. And so if that's something that you need, you should have that discussion early. And you might find out that other financial institutions where you don't have your transactional account may be a better fit. So there's a little bit of kind of due diligence in making sure that you're on the same page with your needs and their comfort. So we talked a lot about that. We talked a lot about documents that are needed, and we talked a lot about the SBA, which is a fantastic partner with SCORE. We do SBA lending because the SBA takes a lot of risk out of loans. We'll talk a little bit about that tonight. And also, I just want to mention that these sessions are streaming on YouTube. And so the part one, if you want to go back and watch part one after tonight, it should be archived and be able to be seen. So you can always reach out to SCORE if you need to before that. Now, if you had a question from last week, or you were thinking about sending me a question, please do. My commitment to you is that if you send me a question about tonight in the chat, I'll stay as long as we need to get through those chat questions. But if something pops up in the middle of the night and you're like, oh, I wish I would have asked that, or I've got this idea, talk to your SCORE mentor, shoot me an email, and I'll make sure either myself or my team gets it back to you. Okay? All right. So just kind of a funny anecdote about the idea of the dream killer. So the dream killer is kind of what I affectionately call underwriting. And the only reason that I really call it that is because I actually knew someone, and she was in the underwriting space for a really long time. And kind of as a joke, but you know how this goes, she got that nickname that she was the dream killer in underwriting for deals. And that it just stuck, right? Like people get nicknames and it stuck. But ever since I started doing these sessions, I'm like, oh, that's what I'm going to call the underwriting section, just because, that kind of carried over. So we're going to talk about how they look at your loan requests different than your actual banker, and then kind of the importance of maintaining that good loan relationship. And we're going to cover how to work with underwriting, how to deal with funding, some of the steps that are important to get to funding, and then, like I said, after the afterlife of funding, what happens with the relationship after you get the money. Oh, all right. So your loan officer, so the borrower is never going to deal with typically never going to deal with underwriting directly. So the relationship that you have with your loan officer, they are going to become the liaison and pass on your packet or their loan committee's packet to underwriting. Typically there's never direct contact between underwriting and the borrower. Not saying that it won't ever happen, but it typically does not. So underwriting, think of underwriting as, even though they might be in the financial institution, think of them as kind of this disinterested third party. So you've dealt a lot with your banker, you've asked for a loan, they've talked with the business loan committee at the financial institution. So, your kind of group is very invested in getting the loan done. And underwriting is really interested in safety, soundness, and risk, regardless if they fund the loan. There's not an incentive, so to speak, for underwriting to approve the loan like there would be for the loan officer or the business loan committee. So they're kind of what I would consider this disinterested third party. If you think of, movies and TV shows, this kind of good cop, bad cop routine, underwriting is kind of the first look of your packet, even though you've probably been talking about it with your financial institution for a while. They want to make sure the business lender and the loan committee are in agreement before they even look at it. So they're really concerned with lender safety, and then of course borrower safety. They evaluate borrower safety, affordability, cash flow, those kinds of things. And then on top of that, there's this regulator function. Financial institutions are one of the most heavily regulated areas in the country. And so regulators want to know that a third party that doesn't have kind of a personal investment in the deal is evaluating the deal kind of from a distance, right? Away from the borrower, away from the loan committee of the financial institution. So, it's kind of that, all right, let's take it from the top. Okay. So on the next slide, what is this good cop, bad cop routine, right? Like everybody kind of has an idea what that is. So now just remember that your banker is working with underwriting. That's the line of communication from underwriting. Now they should be updating you, but if there's requests, it's going to go through your banker, right? What's love got to do with it? So we talked a lot about how underwriting is not in love or not in love with the deal. It's truly a risk and soundness relationship. They might ask your loan officer to ask you for documents that you feel are irrelevant or not part of the deal. So typically they don't really take no for an answer very much. But one of the things that's great from a transparency standpoint is if your loan officer can explain to you, why is that document that I didn't have to supply? What piece of the puzzle does that solve? Okay. And yes, there are sometimes, if you were with us in section 1 and you saw the kind of list of documents they asked for, there are sometimes that you'll say, well, geez, I already gave you those documents. So, and I already explained that to you. And sometimes underwriting, when they look at it, they don't have any of the backstory. Okay, so they're looking at it almost strictly on paper, summaries and documents, financial statements, business plans, all that kind of thing. So they might ask for little things to be explained that you thought you were past. And yeah, that's frustrating. And yeah, that does add to the time. Interestingly enough about underwriting is, they do have the power to say, yes, we recommend funding the way you've presented it to us, which is awesome. They also have the power to say, yes, we would approve this, but we would like to add something that we talked about in part 1 called conditions or covenants. Now, here's the easiest way to remember. A condition of the loan is something that they're going to ask you to agree to. Like, for example, they might say, hey, we're going to ask you to park 3 months worth of loan payments in an account with the financial institution as kind of a safety net for payments. That might be a condition that you would agree to. A covenant is something that you promise to abide by. And covenants are typically written into the loan documents. So they carry a lot more weight when we get to annual reviews, and that's going to come up a little bit later tonight. So they have the power to ask for those things. And you might think that that's unreasonable, or you might think, well, yeah, that's reasonable. I understand that. The communication between underwriting and your loan officer, you just need to continue to ask for them to be transparent as to why, and why does that make sense? Now, one thing that underwriting says is they don't always say no, the actual term no. Sometimes what I see from underwriting is they give you a not recommend. Now, it's not very often that if a financial institution gets a not recommend, that they do the deal. They usually try and rework it so that underwriting is more comfortable with it. But typically, there are instances I've seen financial institutions look at a deal, understand why underwriting did not recommend funding, and through their process, they decided that they were going to take on whatever risk underwriting thought was maybe a bridge too far, and actually fund it. Super rare, super rare. So don't, don't think that's the standard. But typically underwriting is a not recommend and not a no. All right, that's why I put down on this slide, it's no's evil friend. So I hope that makes sense. Oh, excuse me. Okay. So last week's program was called Get to Yes. All right. And so what we talked about is we talked about this idea of this score matrix. Most financial institutions will have a score matrix from 1 to 10. 1 is the deal is perfect. The borrower doesn't need any money. He's got billions of dollars anyway. There's almost no risk in the deal. The collateral is like 2% loan to value. I mean, you never see them. All right. So you almost never see deals scored a 1. Now, typically the deals that are scored like 7, 8, 9, 10 are ones that will be either not recommended, flat out denied, or they're going to ask for some strict conditions and covenants. And of course, risk has cost. Most underwriters, when they look at the risk score matrix from the lender, they really like this kind of 2 to 5 range. We see a lot of deals from 2 to 5 come back as recommends or yeses. And when you start getting kind of sixes is usually where, typically the rate is hiked for the increased risk. I'm not saying that they won't get funded at a 6, but typically conditions, covenants start coming into play. Now, the reason why I put or maybe 8 on the score matrix bubble is because sometimes underwriting has a different scale. So a 10 to the financial institution might be an 8 to underwriting. So if you're communicating well with your loan officer, they should be able to translate that for you. Okay. Because they're probably never going to give you a card that has a number on it, like, oh, this was you. But that's kind of the way that's evaluated. So you want to have those conversations like, hey, one of the things that is fascinating is the uniqueness of every business loan. So sometimes I might look at a deal and say, well, that should be a 3. And then I talk to underwriting, and underwriting looks at it and says, well, I think that's a 6. Now that's a big gap between 3 and 6. It would make sense to me if they said, well, we think that's a 4, and you think that's a 3, because we're close. So let's talk about why we have this gap. But typically when you have this big gap in the score matrix, you're really not on the same page. So either there's documents that were called into question or not quite clear, those kinds of things. So one of those conversations, if you were to get a denial, would be, well, what was kind of the difference between your risk rating and underwriting's risk rating? And that's a legitimate question. I love to have those conversations so people know, they evaluated risk different, or we weren't on the same page, and that's why we got to not recommend. Now, some of those score factors for underwriting, and one of the great questions that I always get, and we got one last week, was, well, what's the minimum credit score? So I don't want to say that there's no minimum credit score, but what I want to tell you is that credit score is not the top factor. It's not it's your ability to repay. And we call that debt service. All right. And so that is the number one thing that underwriting evaluates. Do they have the ability, with everything going on in that business or that organization, to cover this loan debt? All right. Then they might look at loan to value. All right. You're borrowing, you're trying to borrow $10,000 on a, $10,000 pizza oven, right? So you're at 100% of your loan to the value of the equipment. Somebody who might only want $2,000 to buy a $10,000 pizza oven, obviously much, much greater risk profile for underwriting. because you have a lot of equity in that. And in a wholesale safety and soundness scenario, the financial institution is probably going to get pennies on the dollar on your collateral, right? And then they kind of look at credit scores, because the credit score really does give an idea of how well do you handle debt, or in the past, how is your relationship with your other lenders, those guys. We already talked about the score versus score, and then we also talked about business profitability history. So I'll just go over this because this was a very important thing that we talked about last week. So if you're a startup, do not be afraid. Okay. There are places that will look at startups or people who have not been in the business very long. And when you go to make a business plan with SCORE, there's this thing called a NAICS code. And what it does is the NAICS code is kind of all the industries that have history in the United States. And you would say, okay, I make, fuzzy widgets. Is there a NAICS code for fuzzy widget makers? And if there is, you can go, it's free. You can get that information and you can put in your business plan, hey, look, this is my business. This is my industry. So look at how it typically performs. So we can extrapolate from that typical industry performance, how we think we're going to perform. And that's a legitimate argument. So don't be worried about, well, I haven't been in business for a year, all those kinds of things. Now, this goes back to the relationship piece. Certain financial institutions do not care about that. If you have a year, 2 years, 3 years of profitability, then they consider that a good floor plan. But other financial institutions, and of course, I guess I'll toot the credit union horn. We're a little bit more community based, so I love listening to unique stories. So sometimes that business profitability history is less of a factor. Past loan performance, super, super important. All right. SBA guarantees. Now, in part one, I went over a couple slides and kind of showed this example of these buckets of risk and what fills up a bucket of risk. And then we talked about how the SBA guarantee profile takes the risk out of the bucket, which makes the financial institution sleep a lot better at night, because the SBA guarantees that portion. Now, because the SBA guarantees that portion, they're not a lender. There's more paperwork required. And also your history of default with the SBA is important too. So underwriting will look at all of those factors when they go into their scoring matrix. So there are a lot of overlap between the risk matrix of the business loan committee and the business loan officer versus underwriting. But sometimes underwriting looks at things a different way. Okay. And those are all transparent conversations that you should be able to have with your business banker. All right. That was a mouthful. If you have any questions on that, please put them in the chat. Also, I think Bob put in some information about where to get NAICS codes, that kind of thing in the chat. So, all right, let's say that we get past the dream killer. We get past underwriting. The business loan committee of the financial institution has already said yes, and underwriting has says yes or has recommended funding. So if you get a yes or a yes, but here's probably what the next steps are going to be. All right. We talked about in part one, the commitment letter and how important it is to get a signed commitment letter, because the commitment letter spells out exactly the terms of how the rest of the transaction is going to go. And your financial institution should be willing to sign it, and you should be willing to sign it with them. And that's your kind of good, what I might call like a good faith letter, so to speak. All right. That goes both ways. That's the thing that really frustrates me with this kind of idea of pre-approvals for business. Typically pre-approvals, if you have a history with your lender and they kind of understand your business, and that would fly until it gets to the committee and underwriting. But if you don't have a long-standing relationship with your financial institution, pre-approvals look nice. I mean, they look nice on letterhead, but don't be surprised if you run into some speed bumps once you get into the weeds of the deal. And so what might happen is they might say, all right, well, I know that you have this signed commitment letter, but we need this extra condition. And so would you agree to that condition? And if you both agree, then I would suggest making an addendum to the commitment letter saying, okay, now these are the newer terms and we both are in agreement. Okay. If you are purchasing property and you want to kind of start the title process, clearly there's a lien search that's going to be started. So what that means is there something that you're buying that's encumbered by another party? You know, judgments, mechanics liens, claims to that property. So you want to kind of get that started to make sure that there's no title issues. That includes surveys, flood certifications. Is your business in a flood zone? Is that property clear of that? Are the appraisals in? If you're buying property or if you're buying very specialized equipment that needs a specialist as an appraiser, are those back? And does that loan to value fit that commitment letter? Now, I have seen scenarios where there's been a big disparity between appraisal and the need for loan to value and what the borrower thought, the property or the collateral would be worth. And sometimes that financial institution, maybe challenge is kind of a hard word, but they should be willing to have a discussion with the appraiser about both sides of it. Why we think it's worth this. Why do you think it's worth that? That kind of thing. So sometimes there's a little bit of that process. And then also, have you looked over your docs package, your lending documents package? So now in the age of electronic documents, it's a lot faster to be able to order a documents package, review lending documents. And yes, it is like phone book stuff. All right. There's a lot of stuff. It's in small print, those kinds of things. But you really want to be able to have time to review those. Okay. So make sure that you don't have an expectation that you're going to order a documents package the day before you're going to sign them. That's not good for the lender. It is certainly not good for the borrower. Okay. And then is there a clear to close? Typically on certain deals, mostly on real estate, there's a lot of things that have to come into play. For example, underwriting, let's say you want to buy a historic building or an old gas station or a laundromat, something like that. There's a lot of environmental factors that are involved with that too. So part of the yes, but might be, we approve this, but we'd like to have some type of environmental, take a look at this to make sure that we don't go into title with a, contaminated property, that kind of thing. So when you get kind of this clear to close, all of those things are off the table and resolved. All right. So the clear to close is typically, titles done, appraisals done, documents reviewed, all those kind of stuffs we're ready to go. And then the closing schedule. So that's typically kind of how these next steps go. You've got to yes, maybe you have some buts and you've cleared those yes buts off. And now we're getting close to scheduling the closing. All right. Yay. Money. So, congratulations. You've been patient and you understand that the process is complicated and you're going to get to funding. And to get to funding, you have to survive closing day. All right. And so I want to talk to you a little bit about some do's and don'ts, best practices for closing day. Next slide. There we go. Okay. So here's things that I would suggest that you do on closing day. Have a real clear understanding of the documents prior to walking in to sign your documents. And you might be signing those at the financial institution. You might be signing those at home on your computer, or you might be signing those at a title company or a mobile notary or something like that. However, that closing process make sure you have an understanding of the documents. Understand the disbursements and the fees. You should have already discovered, okay, the lender is going to send, this money here, this money there, this money to me, all those kinds of things. These are the fees that I had to pay to have an environmental survey. I had to pay the person to take a look at my collateral. All of those things should have already been reviewed and understood. Okay. And then notary schedules and sequences. I ask that you be respectful to that, because sometimes if you have multiple partners or multiple signers on a deal, that notary service has to travel or get those documents in a certain sequence to make sure that they're all done, they're all correct, and come back in a certain order and all legitimate and all those kinds of things. So just understand that schedule is important, especially if there's more than one signer. And who needs or who is and who needs to be in the room. We talked part one about you may not have someone listed officially as an officer of your business, but typically financial institutions, if you have a 20% stake or greater in that business, you're kind of considered a principal or an owner. So that person may have to be in the room for the signing. And so just know that, know who has to be there. And there's no right of rescission. So commercial lending, this is why the commitment letter and the documents review is so important. If I buy on the consumer side, a big ticket item, typically I have like 3 days to say, okay, I'm not so sure about that. Or maybe I was a little rushed to judgment and I shouldn't have bought that. And so there's some rescission rights in some circumstances. Just know that in the business lending world, that does not exist. So when you sign those documents, you bought it. So, the wheels have been in motion for a while, and we're going to talk about timelines a little bit later. So just make sure that you understand the seriousness of your commitment to it, which is why you have that commitment letter early. So some of the things that are really frustrating for lenders, title companies, notaries, those kinds of things are on the don't side. Don't be late. Punctuality is important for me and important because if you have sellers that have to sign and you're the borrower, and that happens maybe at the title company, they have other things scheduled. They have other business loans scheduled to close. Some financial institutions, the business bankers might have like kind of hybrid remote versus in office kind of post-pandemic thing going on. So, they may have other things scheduled with other businesses, those kinds of things. So once you be on time. Don't attempt to renegotiate the terms. If you go in and you're like, oh, well, yeah, I think that I could get a, 10% or 10 basis point reduction in my interest rate if I, talk to XYZ instead, don't do that on closing day. Okay. You're unless something really drastic happens and you have a good relationship, once that commitment letter is signed and the terms of the commitment letter, that's what's going to be there. Okay. So if you attempt to renegotiate the terms, typically they'll just cancel the closing and you got to start all over again. Or maybe not completely back in day one, but it's going to be a process. And then don't attempt to renegotiate the covenants and the conditions. So I gave you the example of the condition of parking maybe 3 months worth of payments kind of in a savings account at that financial institution as a safety net for payments. Don't go in there and say, well, you know what, I really am only going to be able to deposit one payment amount. That's not something that should happen at the closing day. Now, the covenants, I guarantee you, if you try and renegotiate the covenants, because the covenants are going to be stitched into the loan documents, that will end the closing for that day. So, for example, let's say your debt service coverage or your ability to repay is right on the edge. And in the covenant, they say, okay, your business can't borrow or buy anything that's more than $10,000 without talking to us about it. Because if you added $10,000 more into debt, but you're not taking in any more income, all of a sudden your debt service coverage is going to be below the minimum. So if that is actually in your documents and you try and say, well, you know what, I don't agree to that. I want to be able to buy whatever I want, whenever I want, then that'll be the end of that closing session and you'll have to start all over. And then don't forget to bring all your signers. That kind of thing is important. We talked a little bit about who you should already know who the signers have to be and kind of what order the signers will have to sign. So don't leave them at home. Bring them if they have to be there. All right. Any questions on the closing day stuff? It's a fun day. I'm not trying to scare anybody. It's awesome to be able to get it across the finish line and get rolling. Now, one thing I don't like is I don't like to see this kind of relationship drop off after funding. What do they call it? Honeymoon period, I guess is maybe a common phrase where, everything's rosy. You get the funding, you get to closing, everyone's happy. I've got my new ice cream stand or whatever it is. And then all of a sudden it's just crickets, right? That's typically not the kind of relationship that financial institutions like to have with their borrowers. So what I want to impart to you is we really want to be partners. We don't want to pester you, but there's a reason why we ask for things, and there's a reason why we're going to talk to you maybe more often than you want, but you should kind of know here's the cadence of what's going to happen in our relationship with the lender after funding. Because remember, when I talked about making sure you have a good fit between your borrowing needs and the lender, your financial institution that does all of your transactions might not be the same place as where you're getting your loan. So that financial institution may have a different relationship standard than a lender-borrower relationship. All right. So you should just kind of talk about those things early. All right. With that being said, one of the things that most financial institutions will do on the next slide is they'll do annual reviews. Now, annual reviews also have different requirements based on the financial institution, and typically it has a lot to do with the balance of the loan. So some financial institutions have a higher tolerance, and they might say, you know what, if the loan is under $50,000, we might not do a full-blown annual review. Okay, so that's why this first bullet point, the loan balance, can influence kind of the cadence of how often they do annual reviews. Now, if you borrow $1 million, I'm pretty certain you're going to do a review every year with your lender. One of the reasons why they do annual reviews is to make sure, they lived up to their obligation. They gave you the money, right? Now, when they gave you the money, they say, hey, you got to do a few things. And that's this idea of covenants and conditions. So they're going to review those with you. How did we do? All right. Insurance and financials. They're going to ask for updated financials. You projected to make X profit. How did we do? Insurance is interesting because not only is there insurance on the business, hey, if your ice cream shop burns to the ground, how are we going to be protected? But also some financial institutions, depending on the deal, ask for an insurance product called Key Life. So let's say I talked in part one about this gentleman that invented this contraption, this invention for this tractor trailer. Okay. And he actually brought it to me, which was awesome because I was really having a hard time wrapping my head around what this thing is. Well, to do that deal, the reason why a financial institution might ask for Key Life is he might be the only person in the world that knows how to make it and why. I'm not a reverse engineer. I'm not going to take it apart and say, hey, all right, here's a good idea. So if something were to happen to that owner, then the ability for that product to get to market and get paid for, and of course, fund the loan just disappears. So sometimes financial institutions ask for a thing called key life to protect themselves from that kind of loss. And so we would want to make sure that every year that insurance is still in play. Payment history. If for some reason you're a slow payer, or if you go you don't make kind of sequence of payments as agreed, you're definitely going to get an annual review, because it's telling the financial institution something. There's a problem. There's what are the market conditions? Maybe we understand those, but let's talk a little bit about that. SBA reporting. So if you have a SBA guarantee, there's a report that goes out about the guarantee. Sometimes there's a guarantee fee. And it talks about loan balance and conditions of the SBA guarantee. So we want to make sure we review those. Participant reporting. So in what I mean by this is, in part one of the advantages of some financial institutions is they participate with other financial institutions to get a loan done. So let's say you asked me for $100,000 and I didn't have $100,000 to lend in this particular area. Let's say that bucket of lending dollars was full. But I know another credit union that also allows that kind of lending. And I think the deal is good. It gets through underwriting. And I might say, hey, look, I can fund $50,000 of this deal. Would you be willing to participate in this loan and fund the other 50 so we can get this done? Now, that all that kind of happens in the background. But if there is a participant involved, they might demand an annual review, even if the loan balance is below the threshold where the lead, quote unquote, lead financial institution would do one. All right. So, and then the other piece is, after a certain amount of years, we're going to start talking about term maturity. When is my loan going to be done? Or when is the maturity of this loan going to come up, and how are we going to prepare for that? So I hope that clears up, kind of some of the things that you should expect from your relationship after your loan. So let's talk about maturity, or when your loan is due. So let's say, for example, your financial institution wants to start talking to you like 6 months to a year out. And you're like, wow, that's, my loan isn't coming due, for a year. Why do we want to talk about that now? So think about how long it took to go from kind of your first application. Maybe you talk to SCORE about your business plan, all these kinds of things. You do all your annual reviews, so think about the time that it takes to do those things. What we want to do is we want to allow you as much time as possible to make a smart decision, and a decision that's mutually beneficial. So the first thing we're going to do is ask you for an honest self-assessment of your performance and your relationship with the lender. Your loan might come up for renewal, and you should be thinking, well, you know what? I acted all my covenants, all my conditions, I paid on time. That's a great scenario. But if you said, well, you know what? I know I didn't meet this covenant or this, and I know I'm a slow payer, all those kinds of things. Let's have a conversation, because I know I'm being honest about my performance, those kinds of things. I love the idea of transparency. And just like, okay, look, yeah, we know that we saw, we had to call you and say, hey, when can we expect that payment? These things happen in business. Don't be afraid to talk to your loan officer about it. All right. Get market smart. 24 months ago, borrowing money for a business was a fairly inexpensive idea, right? But if you look at, nobody knew 24 months ago what was going to happen with the Fed rates and prime and all those kinds of things. And those have direct impact on business lending. So if you borrowed money at 3% 5 years ago, and the term of your loan is coming due and you have to renew the next term, you should be smart about the market and what it's doing and how your cost of your funds is going to be impacted, and how that cost of funds impact is going to change your debt service coverage. Okay. So some people, when they look at being market smart, they look at opportunities and maybe they want to renew early. Okay. If they think, oh my goodness, I'm in the 4th year of my 5-year business loan, and I think at the end of year 5, interest rates are going to be 2 or 3% higher than they are now, your lender might renew early and say, yeah, that's pretty smart. Let's renew early so we can lock in this lower rate now that will kind of leapfrog over, what could be a rise in interest rate cost. Okay, so those are important conversations. And then you also have to be prepared. Let's say, for example, your business had this UCC filing, this blanket. Hey, anything that's in your business, if it goes into default, we get to try and sell it and recoup. Well, if you had something in there that all of a sudden you don't own anymore, then you might have to make an adjustment to that UCC, because now all of a sudden the collateral you've pledged against your loan is less. And so, or let's say, for example, a loan to value of the, real estate you bought. Maybe something happened next door and there's more blight or, that kind of thing. And so if a appraisal were to come through, all of a sudden that property value is less. So you have to be prepared if those things happen and you don't think that you're going to have cash flow to cover those changes. Sometimes financial institutions will ask you to bring more equity to the table for a renewal. And then, the idea of, will this loan ever end? So remember, in part 1, we talked about, to help borrowers with cash flow, I might lend you money for a 5-year term, but I'm going to evaluate that impact of that loan over a 20-year, what we call amortization. All right. So if this loan was a 20-year loan, that has a lot less monthly impact than if I had to take all of the cash and consider it as only in 5 years, right? That makes sense, right? Think of buying a car. If you have a 60-month term on a used car, or if you had a 20-year term on a used car for the same amount of money, right? Like, just how dramatic that difference would be. And now lenders do that to help the borrowers approve their cash flow. However, because of that, at the end of year 5, you still have a balance, right? Because you have 15 years, so to speak, that you hadn't paid for that loan. So a lot of times borrowers will say, well, geez, will this loan ever end? And what you're actually asking is about term out scenarios. So let's say, for example, you do a 5-year initial loan and your business is doing great and it's very profitable, and you get to the end of your renewal and you say, you know what, I know I have to renew, but now I want to take whatever my balance is, and I want to do it so when I write that last check at the end of this term, that's it, we're done, and we'll part as friends and that kind of thing. So when a term out is basically you have a zero balance at the end of your term. Okay. Some financial institutions are a lot more amenable to those discussions than others. And, SBA sometimes helps out with this too. If you have an SBA guarantee, there's a maximum length of time. And during the time that you agree, it has to be at a zero balance. You can't do renewal scenarios on some SBA structures. So sometimes that's an advantage as long as your cash flow can handle that. All right. So that's why you have to have those conversations early. Now, a frustrating thing is this concept. And I just want to explain to you that sometimes there's things that are out of your control that you may not know about. So you should have these conversations with your lender. The lender is not obligated to renew the loan. So just because they amortized it for you for 10, 15, 20 years doesn't mean that you're guaranteed to get a renewal. So here's on some of these bullet points, right? The importance of being a good borrower, a good self-assessment. I've paid on time. I've maintained my collateral, so it's not, in poor condition, all those kinds of things. All right. So that's super important. All right. If you are doing all those things, you exponentially increased your chances to get a renewal, unless certain things start happening with the financial institution, which they should be disclosing to you. Concentration risk. Let's say, for example, you buy a investment property and the next 1,000 loans that financial institution did were all investment properties. And they stood back and said, wow, we've got all these commercial loans in investment properties and nothing over here. All of our business loan dollars are in this pool, and that's too much. So as those term out, or if they come up for renewal, we can't renew them. There's no more room in this pool. We need loans in these other pools. Okay. So that's really not something that you can control. All right. But you just have to know that's a possibility. Participant withdrawal. If you have a loan, and this is very higher dollar loans, and they have participants that have those pieces, sometimes those participants say, you know what, after this renewal, we're not gonna jump back in on the balance. So you'll have to either find another participant or take it all yourself. So if that's $1 million loan and you still have $750,000 left to pay, that one financial institution, if they can't find another participant to take a piece of that, it might just be too big for them. Okay. So sometimes that happens. Market forces. Rates are starting to move around a lot versus what they were the last, 12 years before COVID, where it was basically nothing. All right. So sometimes a financial institution might say, you know what, you've got this loan at, 2 or 3% way back in the day. Your expectation now is, 5%, but I'm doing loans at 7%. So I'm going to take those dollars. All right. And I'm going to loan them out at 7%. I'm not going to offer you that at 5%, even though that's more than what you're. So there's kind of those market forces, and rate opportunities. That's kind of the same conversation. All right. So, and then FI consolidation. I've seen this before where you see on the news, credit unions, community banks, regional banks, they gobble up other banks and other credit unions. And what we would consider the surviving financial institution, they might not do business lending at all, or they might only do business lending up to a certain dollar figure or in a certain area. And they might just be like, yeah, this is our, we're now this bank, or we're now this credit union. And I'm sorry, that doesn't fit the profile. So we're not going to be able to renew that for you. So it's unfortunate, but even if you're the perfect borrower, sometimes these things can happen. So when you are doing your annual reviews, ask these questions. Say, hey, tell me a little bit about what's on the horizon for, concentration. Is this still something that you're comfortable with? Because what you're going to need to know is if you're starting to get headwinds or notices that, hey, we can't renew this, you're going to have to find another financial institution, right, to take the loan, and then start that application and the lending committee and underwriting all over again. All right. So that's an important piece. And I don't want people to be blindsided. Like I've seen people get blindsided at renewals, just, because there's some forces that they have no control over. It's all on the financial institution end. Okay. I hope that made sense. Now, one of the things that people always ask me is, how long does it take to get a business loan? Because sometimes you'll see advertisements that are like, oh, you can get $100,000 tomorrow. Well, that kind of goes back to this whole pre-approval idea. You don't have it till you have it. All right. So most financial institutions, they might have small dollar loans that they will absorb a certain amount of risk and not ask for a lot of documents and not ask for a lot of things. But, and then of course, the ability to move documents electronic has really sped up these things. But let's just I'll just kind of give you some realistic timelines. Loan packets. Score does a great job helping with loan packets, but you have to get financials. You have to get a good business plan. The business plan doesn't need to be a New York phone book or a Cleveland phone book. It can be a Grafton phone book, right? Like, it doesn't have to be huge. It just has to answer obvious questions and not create questions. Okay. So, that might take a month. Loan officer review. Once you hand in what you think is a completed packet, that loan officer should be eager to get that back and done, right? Because they're trying to get it across the finish line for you. The loan committee, however, might be in another schedule. Is there a scheduled meeting between the loan officers and their loan committee? Are there participants that have to come in? So those things kind of happen and take time. Underwriting. We talked about how much underwriting might be done based on the loan amount. If you have a very small dollar loan, it might not have hardly any underwriting. Appraisals. If you have appraisal on a property, the financial institution will be able to tell you how long it's going to take to get an appraisal. Now, if you get a good loan to value and everybody is happy about all that, rock on. If there's a dispute process and somebody else has to appraise it, or there has to be a reevaluation by the current appraiser, those things take time. Environmental, it's a very tricky piece. You can do a phase one. Let me just say, some environmental, you can get information from a Freedom of Information Act that'll show you underground storage tanks, all those kinds of things, and you can get that back quickly. All right. But once you get into these more complicated phases where they have to take core samples, or, heaven forbid, if they actually find something, and then you have to talk about, well, are there going to be brownfield funds available to reclaim, get all this environmental stuff? That can take forever. Okay, so if you are dealing in that space where you have to have an environmental, just be patient. Okay. Documents. We can create loan documents once everything is agreed in a day or two. That's a quick turnaround. Title work, a lot of it depends on how busy the title company is or how far back the property goes in time to be able to make sure that you have good title. The thing about environmental, why that's important, is if you go into chain of title on a property that's contaminated and you didn't do your proper due diligence on environmental and get that squared away, you own it. So just beware. And then funding. You've got schedules, right? The schedule of signers, the notary might have to travel, or you might have to meet at the, financial institution, and the lender has a certain schedule. So, but the funding should be fairly easy once you kind of get that clear to close. Now, sometimes people ask me before we get to the Q&A, they say, well, what should come first, the cart or the horse? So when I look at timelines, here's some people like to do some of these things simultaneously. Appraisals, start title work, all those kind of, and that's fine. You can speed up the timeline, but just remember, those are direct costs. So even if those things don't go your way, you might be responsible for those costs. Okay. But if you want to get done faster, just understand that's part of the process. If you want to do it where it's like, okay, I got A, now I'm going to move to B. Now I'm going to move to C, right? Because I don't want to pay for things if I'm going to get denied. That kind of fine. Just understand that the timeline has to be flexible. Okay. So if that's more of your comfort level of the process, start earlier. Okay. If you want to run them at the same time, fine. It's no problem. Most financial institutions that I know, they'll take it in the stride that you want to take it, as long as you're both understanding how things kind of ebb and flow in the timeline. I hope that made sense. All right. So this is my Q&A section. I will stay as long as questions need to be answered. I hope that you had a little bit of understanding of kind of what happens behind the curtain in this part two. If you want to see part one, it's on YouTube. Just reach out to SCORE. They can kind of direct you to that. Also, we will be rerunning parts 1 and 2. I believe it's scheduled for August next year, which sounds like a long way away. It is kind of a long way away. But if you have friends or other businesses that you think might want to attend that, please let them know. Now, you might talk to a business banker and they might say, "Oh, that Dave, he's crazy. We don't do it that way. We do it this way." Okay, fine. There are just as many exceptions as there are rules, kind of like that old English language adage. Certain financial institutions look at things different. They have a different process. I'm just trying to give you some very overarching, things that I see typically. So if you have questions, reach out. If you need clarifications, or if you just want to run a scenario by us, my contact information is there on the left. I promise you, my commitment is that I will answer, or my lending team will answer it as soon as possible to discuss whatever that scenario is. And of course, want to say thank you to SCORE for hosting the series. I love teaching it. I love talking about business lending because every single deal is so unique. And you have so much flexibility to create and get to yes, and get the funding to help our communities. So, I appreciate being asked to continue to teach this series, and it's a mountain of information. So I'll stop talking and see if there's any questions that pop up. If not, I just want to say thank you. And of course, happy holidays, Merry Christmas, Happy New Year, all those kinds of things. So, I don't know if you can see the questions, or let me see if I can look in the.
There is one in the Q&A.
Okay,
Dave.
Debt service coverage.
Yep.
This is, so I'm going to give you an example, but it kind of goes across all industries. Let's say there's two types of debt service coverage. Okay. There's global and transactional. All right. And here's the difference. If I bought an investment property, okay, and that investment property has cost and expense, but I also charge rent. So I have income, okay? The amount of income versus the amount of debt associated with that one transaction, that one piece of the business, is what transactional debt service coverage is. So it's the amount of income that covers over the debt, okay? Now, some financial institutions say that $1.10 for every dollar of debt is a good ratio. Some financial institutions say, well, for every dollar of debt, I'd like to see $1.25 come in. They like that ratio. So talk to your loan officer about what that ratio, what's their minimum ratio. Some places, if they really, some places might be 1-to-1. Hey, we'll look at it as if there's at least $1 coming in for every dollar going out. All right. So that's what they call transactional debt coverage. Now, let's say you own an ice cream shop and a rental property. And let's say that rental property, this transaction here, is only 1-to-1 debt service, right? Dollar in, dollar out. But my ice cream business over here, I have great ice cream. For every dollar that I spend on my ice cream shop, I have $2 coming in. All right. So that ratio is phenomenal. So when I take that part of the business and I lump in the transactional part of the business, now globally, my organization has way more income to cover debt than just this one piece of it. Okay. So you're kind of like averaging out the performance. So when I talk in part one about loving to pay your taxes, on an accounting side, they'll need to understand what the minimum is, either transactionally or globally, to make sure that you have the best chance to either get that loan or renew that loan. And sometimes the rub is that if you show income, what happens? You got to pay tax, right? Nobody likes to pay tax, but you have to show, you can't be, for tax reasons, a lot of lenders understand that, hey, I have an accountant, so I don't have to pay as much tax. Yeah. I get it. I understand. Everybody doesn't want to pay tax. But if you can't show that that business or your global view is showing some kind of profit, you're really hurting yourself. So that is kind of a down and dirty debt service coverage ratio discussion. I hope that answers the question. All right, let's look at what else is in here.
I'm not seeing any other questions, Dave. I have one for you though.
Sure.
So one of the things that we talk about in SCORE is the importance of having a good relationship with your banker. And, no matter whether or not you're in the process of borrowing money or you're just building your business or in some way or another, just working day to day. So tell us a little bit about, the importance of that and, what it would do a, um, if I'm a business, just having that relationship.
So business owners that I know are passionate about what they do, right? They've done the hard thing. They're working for themselves. Okay. They're supporting multiple families, or they're thinking about leaving their job and kind of this whole American dream of entrepreneurship, right? So it's super important to make sure that the financial institution that you deal with is aligned kind of with what your business vision is, right? Some financial institution that might have some familiarity, and then the complete transparency of this is what I'm trying to do. And sometimes, and I've seen it, sometimes you have to be able to take punches when the financial institution says, hey, look, I see your business plan. Here's where I think there's too much risk for an approval. How do we improve that? Financial institutions who really care about what they do for small businesses will help you solve those problems. Some financial institutions only want to churn production, right? So you have to be comfortable, because you're going to have conversations with your business banker that you might not even have with your kids about what's going on with your business and all those kinds of things. And you want to make sure there's alignment, right? And I'm a big fan of, it's easy for me to know stories that are in my backyard. Okay. People that might be in New York City, they might do business lending, but they don't understand kind of the community impact. And it might be hard for them to look outside this little snow globe that they have of your paperwork. So it's important to make that decision. I'll give you an example that I had a business borrower, never met them before, but they were looking for a business lending, and they worked with either SCORE or SBDC, those kinds of places to put a business plan together. And then we had a meeting like, hey, I just, we want to meet with this financial institution. And this person had been in business for a really long time. And all of a sudden in this business plan, they showed like 2 or 3 years of losses, planned losses. And of course, that doesn't look good, right, to a financial institution. But it was the fact that when I asked the question, they knew their business. They knew that there was going to be a road project over the next 24 to 36 months right in front of their business. And so that was going to impact their traffic and impact their income. And they were very transparent and honest and knew that that was going to happen. That goes a long way when you can, for a stranger trying to get a loan, we still have a great relationship with that borrower, and it's been great. So just know that transparency kind of goes both ways, and that holds a lot of weight in community lenders. I hope that answers your question.
Yeah, it does. Thanks. And then Jonathan actually kind of asked the question almost identically just before I did. But he wants to also know who's the most ideal person to connect with within the lending structure.
Okay, so if you call me and we, and I'm here in my office, like I'm here this evening, but if you call me And I pick up the phone, and because my office is local, right? And we talk about it. I'm probably not going to walk down the entire road with you. All right. Either my VP of lending or my chief lending officer or, business lending folks there, I'm going to hand you off to them. Right now, I'm still going to be very much involved. Now, some financial institutions, if you walk in there and talk to a business banker, they might be authorized to say, okay, well, if it's under X amount of dollars, I can do that all myself, right? Like that kind of thing. So it's not necessarily like who you're going to connect with. It's just making sure that who you do connect with is the right fit for your needs. Okay. So some people might say, well, there's these things called universal bankers, right? They do everything. They do transactions, they do lending. And then there's some places that they have very specific business bankers that understand business lending. That's their focus. That's what they do every day. And so you might be comfortable with that. Okay. Or you might be of a borrower that maybe needs a lot more funds. And so you might want to talk with, all right, here's the scenario, but it might be a regional director that reaches out to me, and you might never meet face to face if they're at a different state, that kind of thing. But if you're comfortable with that and that fits your needs, then that's the way you should go. There's nothing more frustrating than starting the process and then doing a lot of work with SCORE, getting all that stuff together, and then all of a sudden the financial institution you thought you were going to have a relationship is not a good fit. So that's very important right from the get-go to understand what's a good fit for your needs.
Great. One last question so far. Are there any tax deductions like depreciation that factor differently in the debt coverage calculations?
Yes, I am not an accountant, but I will tell you that there are considerations for depreciation and how depreciation impacts income. So when we look at it, when underwriting looks at it, you get credits back. If they're appropriately allocated, you would get, you typically get credits back for that.
Good, good. And if you do your financials properly, you should be able to figure out what that depreciation looks like.
Yeah, because
right.
sometimes you'll have accountants that will actually, maybe accelerate your depreciation schedules if that's appropriate for your scenario, and that'd be something you'd want to talk to them about. But yes, we look at that.
Good, good. So far that's all I'm seeing. I think we're caught up.
Awesome. Awesome.
Yeah, yeah. Excellent presentation, Dave. Let me just say that we work with clients all the time, and Dave is really an approachable person, and he's got a really good handle. The information I thought that you delivered tonight was very, very helpful. And there are some frustrating parts of it, but if you've got a good relationship with your banker, those people will help you walk through it. The other thing I would always advise is look at the documents carefully, because the documents are not necessarily made to make you feel good. Those documents are put in there um, so that the bank is protecting itself and watching after its money. So you just got to make sure that you understand that they're not there for your benefit in the way that they will write this stuff. So you need to, even it might even make sense to have an attorney and or a financial expert look over the documents as well.
Yeah, one of the concepts we talk about is bankers are not investors, that kind of thing. So sometimes those documents, there's a lot of lawyer speak in them, and you should understand them. And before you go to that closing, you should know exactly what you're agreeing to, and it should be for some mutual benefit. So, but thank you for those kind words, and I appreciate everyone sticking with us. And I hope to see you in the new year.
Thanks, Dave. Everybody have a wonderful holiday, and we look forward to you joining us with other workshops as we progress through next year. So happy New Year, happy holidays. See you soon. Take care all.